Let's bring on board Irfan Razack, Chairman and Managing Director, Prestige Estates, to talk about what are the new ongoing developments at Prestige. Mr. Razack, thanks so much for waiting by patiently. Apologies, these volatile markets are just keeping us a little on the edge and just throwing up the schedule helter-skelter, but good to chat with you as always. Tell us, that, you recently announced that GIC will be investing in the rental platform, that's Exora. Give us more details if you can in terms of how much are they investing and what is the stake that they're willing to acquire.
See, we've just signed a term sheet with them, and there are some NDAs also, so I can't give you all the details. The only thing that I can say is we are moving towards signing some definitive agreements, and we'll be liquidating a minority stake up to 40% into the rental yielding assets. That's only office property, not retail. And we hope to conclude this transaction, say, by this month end or by middle of April.
There's also been a glut of deals regarding office space, including the recent DLF deal, Indiabulls Real Estate as well. What is it that is differentiating the residential realty market and the rental space? Because a lot of international funds have been investing in the rental space while completely avoiding residential.
See, now in office property, which already is yielding, which is ready, and where the cap rate is known, what really happens is the investor gets in with a lot of comfort. They are sure that the money that they are putting into the whichever company they are investing in, that the yield and the returns are like almost immediate, and there's no uncertainty or there's no question marks. Of course, having said that, it's not a fully rental yielding portfolio. There are one or two which are under construction, which also have been added on to the portfolio. But ultimately, they feel it's a far, far better and secure investment, which gives them the yield. And exit also for them is also very easy. It's very comfortable. Of course, they look at a timeline of 5 to 6 years of exit. So they'll come in now. They'll wait for the rentals to go up, market to pan up, capital values to grow, and the exit happens. So they get the benefit of both. They get the benefit of the revenue that comes in, plus also the cap rate or the exit value is on a much higher note. So they stand to benefit on both counts, and I think that's why the appetite is there more and more for good quality A-grade office property rental yielding assets.
Mr. Razack, hi there, afternoon. Now, you've also created a residential platform with HDFC Capital Advisors to invest in the affordable housing space. What is the rationale behind such a move, and do you believe that there is significant demand traction for this particular space? What kind of, demand are you expecting as a company from here?
This was an opportunity where HDFC was very keen to partner with us and invest in some mid-income housing, and I believe that mid-income housing is the order of the day, and this is where the sweet spot is and where the volumes of sales also happen on a continued basis. And having said that, now while we've signed the platform, you also have to see that there's some deals that happen. And the first deal that we are signing with them is a 180-acre plus plot that we have in Sarjapur, and the legal due diligence is on, and very soon we should be tying that up. Even planning process is almost completed. So once that happens, that will be the first of the deals for the platform. But then there's no sense in just waiting for one deal. Since we have I would say the ammunition, we can use it for many properties across the various metro cities in India. So we are exploring various options to see that whatever the fund is available is utilized, and we are able to create value for both ourselves and our partners.
All right. So can you give us an update on the entire restructuring of your business operations as well? By when do you expect to complete the restructuring? What kind of a timeline do you have in mind?
The restructuring has been done fully last year itself, and consequent to the restructuring, now what has happened is the first step is this move with GIC, then the residential platform. So that will be another step that has happened towards the restructuring, because now we've segregated the hospitality, residential, retail as well as office. So now even in retail, we've also recently, you would have heard that we've acquired the stake of Capital Land. They share because their fund needed to exit. So we've taken over their share, and we continue to operate the same malls that were there. Of course, having said that, there's one mall which belonged 100% to Capital Land in Udaipur. Even that has come into the portfolio. All put together, the retail portfolio also is set to grow. So net, what really happens is, with the capital coming in from the GIC deal, whenever it comes, it really will give us that much more bandwidth to create more assets and more rental yielding properties. And retail also, it will help us to get a larger bandwidth and consolidate our position and grow the retail business too.
Okay, give us a sense as to what the outlook is on your debt position right now. What is the current debt on books and your plans to offset debt pre and post the restructuring as well?
See, the debt is that same 1.1x or 1.05x on the consolidated basis. And these are mostly the SPVs which have got assets like hospitality, retail as well as office. So these are basically self-liquidating debt. So if you ask me, on the residential front, the debt component is pretty small. Even that we are working towards seeing that how quickly we can liquidate our inventory or collect our own money and not rely on debt for the residential business, because since we are in the business of pre-selling and building, we always hit positive cash flows. The only time we need cash for the residential business is when there are sales are poor or there's a cash flow mismatch. But most of the times, the way we've been functioning over the last decade or so, we've always had positive cash flows, and maybe one or two projects which are a little weak are compensated by some other projects. But of course, now with the RERA regime, there's again, you're in a sort of a straitjacket. You'll have to utilize the proceeds of that particular project for that particular project, which is good, which is a lot of discipline it brings in. But having said that, 30% of the collection that is there is a free money which you've already invested. You can take out the land money that you invested. So hence, I think cash flow wise, things can be managed very easily. It shouldn't be a problem, as long as we keep on clocking the sales that we've been doing. And I think the market is pretty healthy. I mean, I won't say that it's very vibrant, but at the same time, it's a steady, solid market. And I think that's the best way to go, because sometimes when you have those peaks and then you get carried away. So it's always good to be secure and safe, rather than trying to have that euphoric feel and then afterwards get into some trouble.
Okay, Mr. Razack, we're optimistic if you're optimistic. Good to hear some positive words on the sector, which